Most people think investing is about picking the right stock or finding the next big opportunity. The uncomfortable truth is that it is not the market that destroys wealth, it is your mistakes. And these mistakes are not rare. They are common, repeated, and often made by smart people who should know better. Today, I'll share 7 of the most dangerous investing mistakes. They may seem simple, but they silently drain portfolios every single day. If you've ever wondered why your investments don't grow as expected, you're probably making these mistakes. So let's break them down. Chasing hot trends. Everyone's talking about the latest stock, crypto, or shiny new thing. It feels like you'll miss out if you don't jump in. But here's the truth. By the time most people hear about a trend, the smart money has already cashed out. What's left is hype, and hype rarely builds lasting wealth. This mistake is dangerous because it makes you act with emotion instead of logic, while also feeling exciting as it triggers FOMO or fear of missing out. You buy high because everyone else is buying, and then you panic when the trend fades and prices drop. This cycle drains your money and confidence. Smart investing is not about being trendy, it's about being steady. Focus on long-term growth, proven strategies, and assets that match your goals. Trends come and go, but discipline and patience are what actually grow wealth. So next time you feel the urge to chase the crowd, pause and ask yourself, is this hype, or is this a solid plan for my future? Trying to time the market. Many people believe they can predict the perfect moment to buy low and sell high. They wait for the perfect time to buy or sell, but the reality is that even experts with years of experience rarely get it right, since markets move quickly and often in ways no one expects. When you try to time the market, you often end up sitting on the sidelines while the best days of gains pass you by. Even worse, you may panic during a downturn and sell at the lowest point, locking in losses instead of giving your investments time to recover. This constant guessing game drains not only your money, but also your confidence. The truth is that wealth grows through patience, discipline, and consistency. Stop pretending you're a fortune teller. The real secret is not timing the market, but spending time in the market. Instead of trying to outsmart the market, focus on building a steady plan that matches your goals and stick with it. Ignoring diversification. Many people put all their money into one stock, one sector, or even one type of asset because it feels simple and exciting. The problem is that when you bet everything on one choice, you expose yourself to huge risk. If that single investment drops, your whole portfolio suffers. For example, imagine a farmer planting only one crop. If disease or bad weather hits, the entire harvest is gone. But if the farmer plants corn, rice, and vegetables, one bad season does not wipe everything out. Diversification in investing works the same way because it spreads risk, so one failure does not destroy your future. Smart investors know that wealth grows steadily when risk is spread out. The market will always rise and fall, but with a balanced plan, you can ride out storms and keep moving forward. Don't gamble on one basket. Spread your investments and let time and patience build your wealth. Neglecting liquidity. Liquidity simply means how quickly you can turn your investment into cash when you need it. Many people lock all their money into assets that are hard to sell, like property or long-term funds, without keeping enough cash or flexible investments on hand. The danger is that life does not wait. Emergencies, opportunities, or sudden expenses can appear at any time. And if your money is stuck, you may be forced to sell at a bad price or take on debt. Imagine you put all your savings into a property worth $100,000. If you suddenly need $10,000 for medical bills, you cannot sell just a piece of the house, so you may be forced to borrow or sell at a loss. Keeping some money in liquid assets like cash ensures you can handle expenses without hurting long-term plans. Liquidity gives you freedom and safety, so always keep part of your portfolio ready for life surprises. Smart investing is not only about growth, it is also about flexibility. What's the point of wealth if you can't reach it when life hits? Emotional investing. In investing, your brain becomes your worst enemy when fear or excitement overrides logic, leading to panic selling during drops or greedy buying in a hype without thinking. This cycle repeats endlessly because these emotional reactions feel natural. And that's why investors keep losing money. Imagine you invest $10,000 in the market. It drops 20%, so your balance falls to $8,000. If fear makes you sell, you lock in that $2,000 loss. But if you stayed invested and the market recovered 25%, your money would grow back to $10,000. Markets will always rise and fall. And while emotions may trick you into reacting, successful investors know discipline beats impulse. When you stick to a plan, focus on long-term goals, and avoid chasing headlines, you protect yourself from costly mistakes. If your trade are driven by fear or greed, you're not investing. You're reacting. The market rewards patience, not panic. No clear strategy. Many people start investing by following tips from friends, chasing headlines, or buying whatever looks exciting. The problem is that without a plan, investors fail to set goals, diversify, or think long-term. That's like driving without a map. You might move, but you won't reach your destination. A clear strategy is like a map. It tells you where you want to go and how to get there. Without it, you may sell too early, hold too long, or jump from one investment to another, losing money along the way. For example, saving for retirement needs a very different plan than saving for a house in 5 years. And if your investments don't match your goals, you could end up with less money than you need. The truth is, markets will always move up and down. They reward discipline, not randomness. Write down your plan, stick to it, and don't let noise control your money. Ignoring risk management. Many investors focus only on how much money they can make and forget to ask how much they could lose. Risk management is about protecting yourself before trouble comes. And without it, even smart investments can become painful losses. Imagine driving a car without brakes. You might enjoy the speed for a while, but the moment something unexpected happens, disaster strikes. Investing works the same way. If you put all your money into high-risk assets without limits, one downturn can wipe out years of progress. Risk management is the safety system that keeps your wealth on track. Simple actions like setting loss limits, spreading your money across different investments, and never risking more than you can afford to lose can make a big difference. The goal is not to avoid risk, because risk is part of growth, but to control it so you can stay in the game long enough for your money to grow. In the end, it is not the market that destroys wealth. It is the mistakes we keep repeating. The real way to grow wealth is simple. Have discipline, be patient, and follow a clear plan, because avoiding these traps lets your money grow for your future. Which of these mistakes are you guilty of right now? Be honest, because admitting the mistake is the first step to fixing it. Thank you for watching. I hope you learned something new and useful. I'll see you in the next video.